CPAs in Canada have a strong brand. Overwhelmingly, Canadians think of CPAs when they think of tax expertise. In 2014, the profession amalgamated 3 legacy professional accounting designations. Then, just after launch in 2015, they introduced an accounting technologist program. And since then, they have been attempting to reposition the brand to encompass advisory services and emphasize management accounting more. However, these 2 initiatives by our regulatory body have both been failures. The Advanced Certificate in Accounting and Finance was pulled 4 years later for lack of interest. And only about 45% of our largest companies have even a single CPA on staff, in any role. Yet 75% of these same large companies outsource tax work to CPA firms. In 2020, the Small Business Analysts Society of Canada was launched. It was clear by then that the leadership of the newly amalgamated profession failed to understand our primary value to Canadians. Internationally, there are 4 leading brands that dominate the global accounting profession. Historically, they have relied on the regulation of audit services to cement their dominant position. However, audits are declining in importance globally. In Canada, audit services accounted for 32.1% of revenue in the industry in 2014. In 2020, that had declined to 25.5%. The Big Four firms managed to replace audit services with advisory and consulting services during the same period. While the Big Four firms rely primarily on audit and consulting services, the more than 16,000 small firms rely almost exclusively on tax and compilation.
More than 99% of CPA firms in 2020 were very small, averaging less than $300,000 in revenue. The remaining 100 or so billed over $14 billion. It's like they exist in a different universe. Understandably, the largest firms exert more influence. However, they serve different markets and have much different business models. These small firms represent a significant portion of the market and actually provide services that are valued by Canadian small businesses. And Canadian businesses are overwhelmingly very small. Our regulatory bodies are bloated and inefficient and generally work against the interests of our smallest firms. The revenue of our regulatory bodies also represents a business opportunity. Currently, we estimate that the 13 separate bodies earn in excess of $525 million from a combination of compulsory continuing education, practice licensing, and members' dues.
When we broke down big firm revenue by employee, the average was about $172,000. According to the Canada Job Bank data, this represents about 2.5 times the median salary for financial auditors and accountants.
Profitability in large firms depends on something we call the leverage model, which doesn't work for small firms. It also depends on a steady stream of bright, ambitious people to accept median incomes of about $60,000 to $65,000 per year. To attract these candidates into the profession, our regulatory bodies publish median income estimates for CPAs that are overstated by 60 to 80%.
In Canada, the accounting profession is highly regulated with 13 regulatory bodies across the country. And each CPA member is accountable to at least 2, their provincial body and CPA Canada. A great deal of the regulations relate to auditing standards, which are largely irrelevant for more than 95% of member firms. Since 2010, when we began flirting with international financial reporting standards, we have seen changes to the audit handbook each year. Changes introduced by the CPA regulatory bodies since amalgamation have reduced the value of accounting practices. At the same time, public accountants are aging out and trying to sell their firms. Whether intentional or not, this had the effect of allowing larger firms to acquire small practices at a discount. This presents a significant opportunity for investors looking to acquire a recession-proof business that is undervalued. The competition is rule-bound and focused on the wrong segment of the market. They have been increasing the cost and duration of education at a time when college-aged persons are outnumbered by seniors almost 3 to 1. By our estimates, the net present value of a CPA designation is significantly less than that of a technician whose education and training are focused on the right section of the market. In short, training should be focused on income tax compliance first, and second on the techniques, technologies, and methodologies actually used by smaller firms. The response of the profession has been to misrepresent the median incomes of CPAs, inflating that value by at least 60 to 80% in an attempt to attract the next generation of CPAs. They have even collaborated with universities to attract non-residents from developing countries. These unfortunate folks are being lured by promises of permanent residence and paying 3 times the tuition of Canadian residents. Many are also forced to pay local immigration consultants for the privilege.
This slide shows that our most profitable small firms have virtually no labor costs. The vast majority of small firms, like those represented here, comprise only 1 or 2 professionals. They earn significantly more than the median income for CPAs in Canada. While our regulatory bodies seem to have tilted the playing field towards large firms when it comes to hiring and training staff, practitioners in small firms have adapted to this reality. And they earn more as a result.
Less than 0.5% of Canadian businesses have 50 or more employees. Of these businesses, fewer than half have even 1 CPA full-time on staff. It seems that most of these companies don't appear to value CPAs as management accountants.
In spite of this, we believe that there is an opportunity for some of our smaller firms to develop the market for fractional controllership. To do this, they need to shift their focus from after-the-fact measurement to managing cash.